Hey everyone, Couch Investor back with the second video of this earnings session. The first one was Mercado Libre, and I want to correct myself. Block is going to be tomorrow. Lemonade is right now. May the 4th is when Block will report earnings, and May the 4th be with you for those of you that are Star Wars fans. Now, with regards to Lemonade, I came into this earnings report with extremely low expectations, even though they said and they delivered last quarter with peak losses, or that it was peak losses in Q3. Q4 was a bit better. Honestly, very, very low expectations. This quarter was actually much better than what I expected. Of course, they did comment on the rise of AI, so we're going to go over that. Now, if you've been following the company for a while, if you've been following this channel for a while, you know that Lemonade, well, is not new in the AI field. The whole company was based on machine learning and AI. That's just how the company was created just 7 to 8 years ago. So to those of you that are not familiar with the company, if you're just looking at the stock, then yes, it has been a horrible, horrible stock. Now the company, since it went public, has only been improving. Of course, it's far from being profitable at the moment, but currently it does go into the right direction. Now that said, there's still a long, long way to go, and I'm not ready to go and add more and more to my position until I see even more, let's say, results of the underlying business becoming a bit more profitable and their systems actually working. Just wanted to make that clear. Yes, I still have a very small position in Lemonade. Do I still believe in the business? Yes, otherwise I would have sold it, but I'm not ready to add more to my position. Even though this was a good quarter, the stock is up, I don't know, at the time of making this video, I think 10, 14%. So I don't know what's now on the thumbnail, but it's up quite a lot. Of course, since it went public, it's down tremendously, but the business has become better. So I'm not going to waste any more time. If you enjoy this type of videos, leave it a thumbs up, subscribe. If you have not, would really, really appreciate that. Trying to cover a lot of company in the next couple of weeks. So if you want to follow along, do subscribe to this channel. It's free. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couch investor. So by the way, the beat on earnings per share, well, on loss per share, expectations and revenue. So nice that. And they also raised guidance by a little bit. So in-force premiums grew 56% year over year to $653 million. Total customer increased 23% to 1.85 million. Then if we look at gross loss ratio, we can finally see some improvements there. It's down 3% year over year, but still very, very far from their actual goal. But we're going to have a look at some extra info about gross loss ratio, X catastrophic events, etc. a bit later on. Gross earned premium increased 61% year over year to $154 million. Now, here they talk and they give us a bit more information. So growing top line, as we've seen before, declining loss ratio, strong unit economics, which is obviously annual dollar retention, now hit an all-time high of 87%, up 5 percentage points year over year, while premium per customer jumped 26%. Now with regards to ADR, still far from the industry average, which is, I believe it was 94% or something like that, but still, this is a metric that I've been saying from the start, which was 81, 82% or so. Wasn't good enough. It's nice to see that this is going up and up. And then improving bottom line at a loss of $51 million. Adjusted EBITDA saw an 11% improvement year over year, while net loss at $66 million registered a 12% improvement. So yes, we're continuing this trend that Q3 has been peak losses and the company becomes a bit more profitable from here. Of course, still losing money, but trying to lose less and less each and every quarter. We're going to talk a bit more about how AI is going to impact the business in a good way. Now, here they give us a bit more color when it comes to the loss ratio, ex-cat. So they give us these numbers right here. So gross loss ratio, ex-cat. In my opinion, let's be honest, ex-cat, I prefer to look at the full picture here, which is gross loss ratio, which is 87%. Of course, if you do ex-cat, it's 72%, which is much, much better. But gross loss ratio as a whole should be better as well. Of course, as they grow into more markets and diversify, that number will become better. But okay, at least they give us some extra numbers here. Also, with regards to Lemonade, they always add new metrics in the report. They also remove metrics from the report. Remember, I think 2-3 quarters ago, we got the mix of each insurance product. We're not getting this in this report. Maybe they'll mention this in the earnings call, which is actually only in the morning before the market opens. Now they say here, despite our reiterated intention to proactively slow growth until more of our price changes are improved, which means passing regulatory approval, which clearly is not the case here. I think that was a question on say. As our Q1 results and Q2 guidance demonstrate, we haven't mastered this maneuver quite yet. While we aim to slow down further as the year progresses, we are modestly raising our in-force premium guidance for the year from 600. Basically, they're increasing at the top and bottom line here by $5 million. And the same applies for adjusted EBITDA. They're raising their annual guidance from negative 245 to 240. Basically, actually a big improvement now that I think of it, about $40 million. Now, with regards to AI, I'm not going to go over all of this. We've talked about AI Gym and all of that. So they, again, talk about and explain their own products. If you want to have a look at that, pause the screen right now. Now, during the investor day, they talked about the LTV 6 model. They are now upgrading to LTV 7 and expected to upgrade even further to LTV 8. So they are saying here, while insurance has a built-in time lag, AI's findings are reconstituted as regulatory filings, which are then reviewed, approved, and begin to earn in. The impact of these technologies is increasingly evident in our results. I agree. Now, they do talk here about generative AI. So they say generative AI, in short, is not a course change for us. It's an accelerant along the very course we set at our inception. As to the impact of generative AI on our business, we will share specifics in time. They say in the coming 18 months, we expect to see meaningful savings in our cost structure. We have identified over 100 business processes that generative AI can automate and improve, and prototyped dozens of them already. This is music to my ears and probably to Wall Street's ears as well. They say here, nevertheless, the first of our generative AI-based automations will make their way into production within weeks, and we expect the benefits of these as well as subsequent rollout to be somewhat impactful on our financial late this year, already reflected in our updated adjusted EBITDA guidance. All right, makes sense. And more significantly impactful in 2024 and beyond. Again, this is something that Wall Street likes to hear, but then again, it's a story of, okay, now show me what you've got. You've promised me something. Try and reach that goal and maybe even do better. Now, with regards to the reinsurance agreements, right, the seeded one. So they say here in June 30, 2023, their current quota share reinsurance agreement expires. Now, I'm not going to try and speculate and go all over this because they say here, once the accompanying deals are inked in the coming weeks, we will share all of the specifics. So I'd rather wait to get the specifics and talk about that. Maybe I'll create a community post. I'll create a community post anyways tomorrow after the earnings call, going over the most important points. Then when it comes to second quarter guidance, in-force premium between $665 and $668 million, gross on premium of $156 to $158 million, revenue close to $100 million, so at midpoint of $97 million. Adjusted EBITDA, still a loss here, $56.5 million. Then stock-based compensation doesn't really move much, is at $15 million, which for the full year they expect again the $60 million there. For the rest, we already talked about it. In-force premiums, $5 million increase there. Adjusted EBITDA loss, $40 million increase in the good direction. Then revenue of just under $400 million. Gross earned premium of at the midpoint of $647.5 million. Now, overall, again, my expectations were very, very low. They were met and then some. I liked what I read about the AI effect on the company, generative AI as well, and how quickly they are moving there and how quickly this will impact the business in a positive way. To me, that's good, but not good enough right now. At least for me, I need to see more to be comfortable to add to my position. Because right now, to be honest, the market is still very, very volatile, still high interest rates. So I'd rather keep my cash on the side and add to more, let's say, well, larger business that generate already a lot of cash, such as Tesla, for example. And I might or I might not have bought another fintech company yesterday. I can't say the word, but you might guess which one it is. And no, it is not Block, because they report earnings tomorrow. So that will be it for this video. Of course, do share your thoughts down in the comments below if you're still holding the shares. If not, let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.